Hello, hello.
Hello.
How you doing?
Excuse me for a moment.
Sure.
My girlfriend's cleaning the freezer.
Oh, what did you do?
It's to be some ice filled up.
Yeah, never a good sign.
How are you doing today?
Doing fine. Still chipping away at my Tesla model. Yeah, not bad. You?
Nice. Yeah, not bad. Been on my schoolwork today, which I'm going to do on Dynatrace. It's like an big investment thesis. Got to tie in macro and do a DCF and stuff. So
Oh, okay. You're
good,
doing
good
DCF?
opportunity.
Cool.
Yeah,
Good stuff. Good stuff.
yeah. I've got Needham's model to work with, so should be a nice assist there.
Mm. Yep, totally. Uh, yeah. I mean, I think the more I do models, the more I realize it's just a calculator. Yeah, it's the views that matters. Oh, hi Mel.
Yeah, completely agree. Hey Mo, nice new picture.
Hey
Welcome.
guys.
Wait, I still have the old picture.
What old
Hmm.
No,
picture?
Your profile. I actually saw it on the Outlook. The new one looks sharp. Like I still have the old one in Teams. Maybe I need to update my system.
I didn't realize that my I must have
That's your Twitter
I
one,
think I
right?
updated I think I updated my the like the profile picture on a it's like a Microsoft like admin like page because I didn't have a picture on it and I updated it and I guess on some of the apps it's updated but like on Teams it still shows my old one. So I
Yeah.
don't know what happened.
Yeah, maybe I need to get one too. I look less young.
There you go.
All right, let's kick it off.
Right. So a pretty interesting continuation of the week where we pretty much have seen the Russell index scream higher. I spent this was like a big discussion point in one of the Bloomberg chats that I was in. Just kind of like thinking through what it actually means and whether it's an actual like bet on, the elections or whether it's just seasonal quirk. I think right now most of us are in the seasonal quirk camp and think that it's like, you know, uh, uh, you know, uh, um, a signal that equity markets will probably underperform, in the near term. I sent you guys, I think, that image of the spread between the Russell and the S&P on a one-day change,
Mhm.
and did it on a 2 sigma, so over a 250-day period, so you can kind of see whenever that we hit some kind of a breach and you get this really intense outperformance. It tends to presage a recession. So I'm not saying that this is a recession call, but if you look at what happened in the rates market, it's largely consistent with what we saw. As bond yields tumbled 2 years down to 4.41. The 10-year is down to 4.15. So this is a pretty significant move. The July cut odds are still about roughly 6.5 to 7%. And so I think that this is, uh, just an expression of, what happens is if you think about like, when investors begin to position for maybe a little bit of a slowdown in the economy, they're probably going to express that mainly on the S&P. And so they will start to maybe cut back on purchases of the S&P. and then or they'll maybe start to short against companies that they don't like, or that they think will underperform. And in this dynamic, you still have, like, say, positive seasonal flow that goes into your passively managed portfolios. And if those are still broadly buying, a broader index, then you would expect to see like a Wile E. Coyote moment where, people are just, every 2 weeks, people put money in their 401k or into their IRA, and that marginal purchases like keeps buying. And so that's not like super price sensitive. That tends to kind of lead to a surprise, and it's why you often will get like a little bit of a like a hangover even after you would expect that, you say, positioning would flip. So I'm not saying that that's what would happen, but I'm saying that the Russell move is not consistent with the move in the rates market, and but the equity move in general has been roughly about what you would expect. So given that dynamic, I think that's probably what's at play. I don't think that it's necessarily like a quote unquote Trump trade. I think that it's more about that seasonal overhang, and probably will set up Russell for some sort of a surprise.
Wait,
What do you guys?
what's the argument for it not to be a Trump trade?
Well, if it's a Trump trade, for example, then you would see that bond. You would see a bear steepening, right?
Okay. Okay.
So, so if you think through like what is the like the mechanism of things, right? So just so for example, there was a discussion that I was having in Bloomberg. So I'm just going to read through what it is. So what I said was, so someone said that let's see. Well, I guess I started the conversation saying that it reminded me a little bit of the December rally that we saw. So if you guys remember what happened in December, everything jumped, pretty much rallied like crazy. And so someone else commented that, yeah, they think it's all positioning too, just like the December event. One of the other guys mentioned that IWM was running out of upside strikes at this rate. So in that case, it's trading like a meme stock. And then we had a discussion about like the economic sensitivity of, say, like the Russell or like mid caps to US GDP, right? And so because of the sensitivity, you would expect that if economic data were to continue to surprise lower, then earnings revision estimates would move lower too. And so in that scenario, you would expect Russell to continue to decline. Now the counter argument was, well, in the 2016 Republican sweep, the Russell outperformed the S&P 11% from the day before election to peak, and then much more if you zoomed out to the beginning of January 2016. And then what the guy cited was banking deregulation, corporate tax cuts, and a business-friendly government. So, what I said in response to that is, okay, I get all of those things, but that would ultimately lead to a bear steepening. And right now we're getting a bull steepening. So the rates market disagrees, and it's unlikely to change unless the Fed says that they're going to start hiking again, right? So in the current scenario which we exist in, NIM goes much lower, and NIM is net interest margin, right? And then because current SOFR curves are still pricing like a higher for longer, there's like still material upside risk to say what's going to happen with with NIM. So that's pretty bad for financials, which make up of a major constituent in the Russell. So someone was like, well, is it because we're so accustomed to mega caps and semis outperforming every day that we can no longer imagine the reverse happening? And I said it's not really that, it's just more about the regime and what we need to happen for mid caps to outperform. With the data getting weaker, economic revisions are going to have to be revised lower, and that means lower, Russell earnings. Multiple expansion could offset that, but the Fed is like not positioning for that. The Fed is being coy, and it seems to me like July is going to be more about like patience and we're on track, so on and so forth. If the Fed does do a surprise cut in July, then that could potentially flip the regime, and that would drive a steeper yield curve. That would be positive for 2025 revisions. Yeah, Russell could outperform in that environment, but data is pretty weak, so not sure that's going to happen. The guy responds and says, and the guy's like a CIO, a chief investment officer at like a pretty large asset manager. So, he's, pretty smart guy. He was saying that, if you ignore the economic cycle for a second, he said, actually just like focus on what's going to happen if there is a red sweep. He said, if that happens, doesn't the Russell earnings have a larger magnitude of positive revisions versus the S&P? So I, was like, well, I hear you, but if you thought that the economy was going to surge, then you would think that deregulation could be a positive impact to margins. But if falling demand is a problem, then it doesn't help. So, if you think about like energy sector, for example, energy needs a global pickup in activity. Drilling more just means that prices will be marginally lower. So Trump policy of drilling, more oil is not going to help energy companies. For banks, lower NIM, right, because of Fed easing, means that, earnings are going to come down. So then he asked about corporate tax cuts, and I said that, the thing about it's not the corporate tax cuts, like the way to understand it is it's kind of like a fiscal transfer, right? So if corporations make more, like collect more profits, then they'll distribute those to shareholders either through buybacks or through dividends. And when that happens, the people that disproportionately own companies are already very wealthy people, right? So all you just end up with is money flowing from, say, like the public sector to wealthier households. And because wealthier households don't spend that much, their propensity to spend, their, like, say, beta for every dollar is very low, you don't get a big multiplier effect. You're not going to get like a big tailwind to growth or to demand, like consumption, like the C in GDP. You're not going to get a big tailwind to that because corporations aren't getting a bigger tax cut. If you saw that there was like global demand picking up and you offered a tax cut, yeah, that would increase supply. And then that meant that companies would generate more revenue. But in this case, if you thought that the economy was going to be, say, neutral, companies aren't generating more revenue, they're just collecting more profits. And so that just ends up being a tailwind for, people that already own financial assets. It doesn't actually lift GDP. So in that case, it wouldn't lift revisions for, mid-cap companies. So I think that's like a big thing. Another kind of thing too is questions about like how tariffs would impact things. So, or even like how the tax impact of stuff impacts stuff, or like how changing the tax rate impacts the company. So I was saying how like taxes, the tax impact is on EBT, right? Like we know this because we build models. So we know that like, well, there's taxes are applied to earnings before taxes. They're not applied to revenue, right? And EBT is after EBITDA, right? So it's after the operating and gross margin considerations. So in an environment where like you have cooling demand and you have tax cuts, well, the government, in order to fund the tax cuts, it's either going to have to issue more treasuries, which would lift the interest rate, or they'll increase, or they'll have to cut spending. Okay. If they cut spending, where does spending dollars go? Does it go to like poor people or does it go to rich people? Primarily goes to poor people. So it's that cohort that would be disproportionately impacted. And in that dynamic, Trump would start to see, or like, the White House would start to see weaker economic activity. So what's going to be the fiscal response? Stimulus. Okay, so like the consequence of a major tax cut is going to be future stimulus. Okay. Okay, so if they do more stimulus, that's going to be a higher fiscal impulse. That's going to push long bonds higher. So you're going to get this, steepening that takes off. So my whole point was that no matter how you slice and dice it, a Trump presidency means a steeper yield curve, and it'll be driven by the long end being sold. Okay. So that's the Trump trade. And another thing too is because Trump is staying, and I don't know, like you can't really believe anything that they say, but he says that he's going to do this 10% tariff. He's going to do a 60% tariff on Chinese goods. So what's going to happen in the near term? Well, a tariff is going to raise prices. So if he does a 10% tariff, then prices are up 10%. How do we measure price inflation? CPI. So CPI then resurges, goes from 2.8 to 10%. So what does the Fed do in response to that? The Fed is going to raise interest rates. So what ends up happening is you're going to end up with you'll ultimately end up with like a bear flattener, okay? A really weird looking inverted yield curve because the front end, the 2 to 5 year is going to be much higher. And the 10 year is going to be like steeply lower. And the reason why is because on the long end will be like probably I don't it will eventually settle lower than where it is now. The reason why is because the expectation that the monetary policy response to the fiscal and the trade implications of a Trump White House would ultimately result in a recession because the Fed would have to jack up interest rates again. So like Trump would have to spend a similar amount that the government spent during the COVID crisis in order to really offset that, and that's unlikely. So that really limits, what'll happen there. So yeah, like the end result is we'd get a bull or a bear steepening, and then that would end up settling into an inverted, yield curve where the front end would be much higher than where it is now, and then the back end would be probably a bit lower, probably around 3.5. But the front end would be like 6 to 7% because like literally it's just like the tariff implication. Like we get so many goods and services through trade that if you have 10% increase in tariffs, you're going to get like a pretty substantial increase in prices as well. So that's like the setup. So that's the actual Trump trade. So the actual Trump trade ends up being a really strong dollar and an inverted yield curve sold off pretty much. Yeah, the equity impact multiples would expand. So you would actually see duration would begin to outperform. The Russell could trade higher, but like it wouldn't necessarily like be the like the Nasdaq or long duration. And so I think that's kind of the consideration here. So like in that environment, yeah, you could have the Russell perform very well, but you would see rates sell off. You'd see the dollar strengthen like crazy. And that's how you know it's the Trump trade. Today, we get a massive, like yields are down substantially, right? The 10 years down 7 basis points. That's a pretty big move. And and then you had this like mixed equity performance where, the Dow is up 1 point, almost 2%. S&P and NASDAQ were, much lower. And then, the Russell had a massive outperformance. I think it's up like 3.6%, today. So that is something else. Like that's why I'm like, this is something else, right? Um, and I think it's more about just like marginal positioning. Are there people that are saying this is the Trump trade? Oh, for sure there are people that are saying that this is the Trump trade. But I just think that they're wrong. Like it's not going to have like subsequent flow. If it's going to be the Trump trade, then you'd want to get long, because if you thought that Trump was going to win, because then you're saying that, okay, you could expect a Russell 2000 outperformance versus the S&P over like the next 6 months, right? So you'd want to get long now. But because I don't think that it's a Trump trade, it's more of like, well, you're going to want to fade this at some point. Right now, it's probably too early.
Yeah.
So what one of the guys was saying was that the way that you trade this is you just do a bunch of call spreads until it stops working. So I don't know. Maybe that's the trade.
That's on Russell?
Yeah.
Oh, I see. So that means like the current like view is like this momentum is gonna last for a while.
Well, it's just you don't know like how long it's going to last for.
I see.
And so because you don't know how long it's going to last for, just buy call spreads and then until they stop working.
I mean, this is like your view, or it's like the that chat's view?
Oh no, this is Paul's view.
Oh, I see. Do you agree with him, or
He knows more than me, and that
I
like
see.
I mean so I would defer to him. I'm not sure if I agree with him, but I definitely defer to him. He's much more um yeah, higher level. And you've spoken to Paul before.
Oh,
No.
one time, late call was pretty fun.
Yeah, he's a good guy. Ex-Goldman, now at Millennium. Macro PM there. But his specialty
Also
is really on the
ex-City,
derivative side.
Mm.
Yeah.
Yeah.
Yeah, he's more of a vol trader. I actually, speaking of people, I put him in touch with Serge. Next time I'm in New York, every time I get in New York, I try to do like a get together and like a dinner party, and like get everyone together. And actually last time, Jeff like knows these people. I actually had Serge, Jordan, and Z came. And the day before they came, actually Jay, I went out with Jay for an omakase. So sadly he was only in town for the day, so he wasn't able to make it to the dinner party, but it was good to see him. Anyway, that was just side chat. So yeah, that's like the Russell positioning. We're about to enter into earnings season in earnest. This week I'm gonna start off with IBM and Netflix, and then it's gonna just ramp up from there. So over the next couple of weeks, there are a few things to keep in mind. One is structurally for like the Nasdaq and for mega caps, we're in like a blackout period, and so typically the buybacks are paused through the earnings, say period. And you can actually count how many like companies, will report in like the cadence, and people do this actually. Goldman, I think Mike Nocerino at Goldman puts out a good note where he will kind of like get the distribution of companies that report and like the dollar value of their buyback plan, and then like actually measure what the impact is on a daily flow basis. And so, it's not, there's always this little bit of a chunkiness that happens in the first half of earnings season because most companies are in that blackout period, and then it starts to pick up in the second half. So it's, that's just something to kind of keep in mind. That's more of like a seasonal thing So because it's like a season, or I don't want to say a seasonal, a seasonality thing, because it's more of a seasonality thing, it means that this is something that like happens because of, it's not like information has come out. It's just it's a structural thing, right? And so we have to assume that the market like pretty much already knows this, and that this shouldn't have like a disproportionate impact unless volumes are much lower than normal, right? Because when volumes are lower, then all of these guys re-engaging in their buyback plans is going to have a disproportionate impact on, on a thin tape. So that's kind of the dynamic to watch for. So I think that like where we are right now is, we're right before earnings season really begins in earnest, and so we're in that, I don't want to call it an air pocket, but a little bit of, we're walking on thin ice, um, just because there's a portion of demand that's like, of purchasing demand that's not there. So it's going to be interesting. I think another important factor too is that, we have the FOMC meeting on the 31st. That's obviously going to have, a material impact, but ultimately kind of going into that event, and this is something that, we've spoken about a lot, but it's, there's, so from a seasonality standpoint, we're in, blackout period. So the last 2 weeks of July and into August tend not to be that great, like historically on like a seasonal basis. I think primarily because of this, buyback deduction, or marginal change in the amount in the units demanded in the market. And so given the backdrop, you will see like that where price goes is less informed. And so you kind of want to fade any like large move. And you would expect that the informedness starts to get back in as we go through time and volumes begin to pick up, right? And that should be sometime around like maybe after the first third of earnings season goes. So I think probably around the end of July is like the real catalyst, because that would have given us about 2.5, almost 3 weeks of earnings and FOMC. So it's going to be like, it's going to be a lot. It's going to be interesting. What it also means is the immediate after effect of FOMC is probably going to get a little noisy. My assumption right now is that, interest rates have moved in quite substantially over the past couple of weeks, because investors, it seems, are positioning for what's going to be a much easier Fed. However, I still think that we're probably due for, I'm saying now because of how the market is positioned, I think that we're probably due for a bit of a surprise, in the sense that I don't think that the Fed is going to be as accommodative as the market thinks. And like the key comments that, that I've really paid attention to are, the things that like say Mary Daly or Jerome Powell says, and some of the things that, I've really paid attention to is the fact that Powell is still talking about quantitative tightening, right? There is not there's also this behavioral construct, right? I think, I was talking to you guys about this a couple of weeks ago, but there's the behavioral issue, which is sunk cost fallacy and anchoring. Like they just in the June FOMC, like, can you believe it? Just a month ago, right? They raised their like interest rate expectations or their interest rate outlook for the next year. So, and they didn't lift their GDP estimate, and they didn't change their GDP estimate, and they marginally raised their unemployment, estimate. But so that's the setup. And I think the Fed is very cognizant of that. I think the markets know that the Fed is kind of like is it kind of in a corner, but the market now thinks that the Fed is going to blink, right? So earlier on the trade, I was like, yeah, fade the Fed, fight the Fed. And now I'm like, oh, people have gone a little too far fighting the Fed, and now they're setting themselves up to be surprised. Like I said, we've not gotten any indication that the Fed is going to actually, I don't think they're going to make a cut. I mean, that's the right thing for them to do, but they've not given any indication that they're going to give a cut in July. And then the other thing too is just the language around quantitative tightening hasn't shifted. Like once that language shifts, then that tells you that the Fed is like everyone is focused. Right now, the fact that we don't have the fact that that's not an issue tells me that people are still not focused. Like people still think that there's still a lot of diversity of views at the Fed. And when there's a lot of diversity of views, you know, the best thing for them to do is just to wait to pass. And so that I think that dynamic is going to be really key. We'll see what happens, you know, in the run up. I think we're about to enter into the blackout period, you know, this weekend. So that'll be the end of any Fed speak. But I've not seen anything that really counters that. Have you guys, you know, any thoughts there? I know that, you know, Andy and you know, yeah, like you guys both track the macro side as well.
Yeah, I mean, oh, sorry. Yeah, I thought Yafen was saying something. Yeah,
Oh, I see. I was muted.
yeah,
Yeah,
I
you can go
mean,
ahead.
yeah,
Yeah, I
like
was.
I mean, there's always this risk that a Fed makes a mistake. You know, they're not perfect, although they try to be. But like you know, for me on the macro side, you see today that retail sales, you know, auto again is the lagging factor. You know, for my coverage. And it's kind of, you know, the writing has been on the wall for a while that this is one of the sectors that requires the most amount of, you know, consumer like consumer pocket or like, you know, deployable incomes or savings. So if that's down, then it's definitely not good news for the consumer. And I've been seeing headlines about you know, also the delinquency rate today. So yeah, so that's like one of the, you know, red flags for me, you know, going into the summer. And you know, but I think I'm on the same page that the Fed made a mistake in June, but they need to start walking, you know, walking back. Otherwise, they're going to be behind the curve too much.
Right.
Oh, I mean, just quickly update on the GDP now forecast.
Then right after the retail sales, it went to 2.5% again. Um, so yeah, I'm not sure like if that's kind of like, I mean, I did like read like the, for example, the Ian Shepardson think this is kind of like a weather-related blip,
Mm-hmm.
you know, retail sales, and he thinks like the next two prints will be like lower. But yeah, I mean, like this like GDP nowcast for Q2 is like quite volatile. It just like went to like 1.5% at the start of the month, and right now it's kind of back to 2.5%. Yeah, and I think this is kind of like I'm like overstating the growth, but yeah, we'll see. I mean, now Thursday. Today there's like a housing market index updated as well. NAHB, it's like the housing price. Let me see. Have the NAHB housing market index. Yes, that's kind of like a slight miss. So like new home sales is like weaker. Yeah, I mean just like although like we have like probably like a rather like promising retail sales print, but the case is still for like a consumer slowing. I did like type something about the oil price. Yeah, I think the we're already like heading towards like the second half of the driving season. It's like from like May to August. we're like already like over the July 4th long weekend. So yeah, I think
Right.
like the demand is kind of like we have like probably peaked already. Like today I checked the TSA passenger count, and it's like I think the July 4th average is like close to like 2.9 million to like 3 million per day. Like a lot of people are traveling. I think that's kind of like gonna slow down a little bit in like the coming weeks. Yeah, I think today like the crude oil has like it's also down. It's probably like down 1 or 2%. The number has already refreshed because like the CME already opened to the next day. But yeah, I can check later. But anyway, like the today I think I saw like the oil prices down like more than 1%. So yeah.
I mean, like with a weakening consumer and therefore the economy, I think the debate right now has to shift to, how many cuts rather than when they'll cut. Like even though if they cut one time, like one time in SEP, and so what? Like what's the really impact on the consumer if it's just 25 basis point? Like like how much we're doing, and like more like the terminal rate where we'll be ending up is, I think, a more important debate right now.
Right. One of the things I thought was really, really interesting was so like the IMF put out the latest WEO, their World Economic Outlook, and they update it, or they put it out at the beginning of the year, and then they update it, or they put it out in October or one of the months, and they update it another like 6 to 8 months later. But in the report, I mean, they're citing U.S. GDP growth at like 2.5%. And so I think that, there's still this like, I was telling you guys that there's this, the CBO numbers, people take that as an input in their analysis into like a DSGE model. And so, I think that it's gonna like, why are people going to be wrong? It's like that's why. And by the way, like the latest update on border crossings came out, and it's weaker now than it was even in 2021. So it's a total like reversion of what people are currently embedding in their models, right?
Yep.
Like that scenario's out, but people are still pricing it in, and I think that's gonna provide a surprise. Going back to like oil, I think the right way to look at oil is I don't really care about oil moving a percent, up or down. I think what really matters is always like what are the scenarios out there, and then look at what positioning is on the contracts. And then from there you can see how those, like prices are going to fluctuate, given that. And then I don't care if oil is down 1% or 5, if it's down 5%, that's like a more volatile move. So I would expect that it wouldn't move over, say, 2% on any given day unless there was some information. And why 2%? I mean, you just grab the historical data and find what the sigma event is, right? So, that's the thing, like a 1 sigma event or a 2 sigma event. What anything within that is normal. And so what really matters is what are the different scenarios for the price of oil and where are we headed? Well, we kind of had a long view, and I actually closed, my oil long position, some time ago. But yeah, we had that long oil view, from when oil was trading at like closer to like in the mid 70s, right? And so, yeah, that was decent, and it was based upon this view of some improving, like you could say that the at the time the dynamic was such that oil prices were not reflecting like a buildup, and like given what the trend of data was pointing to, the oil market was not pricing that in, right? And then after data has come out, now it kind of shows that, well, the demand profile has actually diminished. And so in that environment, yeah, oil is now, the upside scenarios are now substantially at risk. So I think that's kind of how we want to see it. But I think it's better to look at oil at like a level versus just a price change, unless it's like a 1 or 2 sigma event. Then you can say, oh yeah, it exceeded that normal move. So yeah, I think that's how I would kind of approach oil. Now to generate the view, right, you got to think about the scenarios out there, right? So so like what are the critical factors for oil? Inventories, production, okay? Those are 2 big ones. That's on the supply side, and then on the demand side, it's going to be, growth. So what are the different scenarios for each of those factors, right? You just make a matrix and you say, okay, and you can start simple and just be like, well, what's the upside GDP case? What's the downside GDP case? And where's consensus? And you can just work your way backwards. Okay, now upside case, what does that imply on, existing inventories, right? Or what does it imply to existing production? Can production move higher, or is production already too high? Right. So then you can kind of work your way backwards, and then you can do the same thing from an inventory and production standpoint. Look at production and look at the inventory. Look at like EIA and the IEA. I know it's kind of confusing because they both sound similar, but you use those. DOE, the Energy Department at the United States, they also provide some good color and good data on um, on what's happening in energy markets. I believe that they actually put out like a monthly report, including a forecast of what they think is going to happen to prices, which is pretty useful because they have a really good, it's always specifically wrong, but it can be helpful for us because we can learn about stuff in the intermediate, stages. So that's like those are like the data sources to help you understand like, well, where are inventories and then where's production. And then Refinitiv, yeah, thank just so that like Refinitiv is probably better in commodities than Bloomberg. Um, I would say that Refinitiv is like if you're an oil trader at Chevron, you probably use Refinitiv. If you're an oil trader at a prop shop, you're probably using Bloomberg, right? So Refinitiv is actually has a lot of great resources and great depth in their product offering, and you should be able to track a lot of this information. But they also have like analysts that cover what's happening in energy, and I recommend that you like subscribe to those newsletters and across any of the things that you think are going to be important. And then you see like you learn where the panels are, and then you build the setup. You know how Andy and I we have like our we create like these screens, or like you've seen my desk. Like I have all these like little windows up. You can do the same thing with Refinitiv as well. And so I recommend like having a layout. Now the cool thing with Refinitiv is you can switch between screens pretty easily. Bloomberg has that feature too, but Bloomberg lags like crazy. So I never take advantage of it. But um Refinitiv was always a little quicker. And so with Workspace, you can create your layouts. And what I would do is I would have like a general layout, like what's the layout that you use when you just like log in? And that I normally just make pretty simple. And then specific workflows, like, okay, you want to analyze like US rates. What's all the layouts you need to have for that, right? And then like, okay, you want to analyze oil. What are all the layouts that you need for that? You need to analyze, for whatever it is that you need to analyze, I recommend having like a different layout for that because it's just going to help you. Because that way you don't have to like go back to square one and reopen all those apps and so on and so forth. I think maybe one of these weekends I'd be happy to like walk you through how I would do that. This week is a little tough because I need to finish my earnings previews, and I'm going to be flying out to Texas, so I'm not getting any sleep. But probably on the weekend I'll have some time to help.
Yeah, sure. Thanks.
Cool. Yeah, I think for the commodity backdrop right now is a little weak, but the way that I'm going to approach it, and this is where you're going to be able to really this is like I'm going to say like a big this is like the dance between like a PM and an analyst generally is that the PM is often going to unless they're covering the asset. Like, if there's something that I cover, like for example, because I do cover interest rates, I am say analytically covering interest rates as well. But generally speaking, the for things where there's an analyst, the PM is going to act as the outside view, and the analyst is going to act as the inside view. And as the two interact, you're able to like improve a view. Like the sum of the parts is better than any individual like effort. And so that's how we should approach, whatever you're thinking about like on the macro front. That's how we want to, leverage it. I'm always going to try to take the perspective of like almost like the opposing view. And it's not because I disagree with you or, I don't think that you did work or blah, blah, blah. It's just because this is how it works on the buy side. Someone has to play the devil's advocate. And that's almost always going to be like the PM because the analyst is often bringing something, over. So um, if you get a lot of that from me, it's take it as a sign that I'm actually really engaged and I actually think that you're doing really good work. If you hear that I'm just like agreeing with you, it means that I probably just don't know enough to give you good feedback. So just want to give you guys a heads up as we kind of get into earnings season and practice more views and set more views. So that hopefully should be fun. But I wanted to kind of clear the air there and forewarn you guys about that.
It's gonna be good if it comes with a warning up ahead. So.
Right, exactly.
Mo, what is your source for the border crossing data?
If you just go to Google and you do nationwide border crossings, I'll send you. It's the U.S. Customs and Border Protection. So I'm sharing it in the chat.
Okay, CBP.
And you just or cbp.gov.
Yeah.
And if you just scroll down, you see that chart.
From June 24.
Yes. So you'll see that June 24 is just under where it was in June, 21 and 23. And there does seem to be some like seasonal, aspect, right? Like for the past couple of years that, outside of 2021, right, when borders began to reopen, that seemed to have been like where seasonally there was a little bit of a doldrum. But we've kind of crossed, below that, and the trend, is moving lower. Now, I would say that it doesn't even matter that the trend is moving lower. Even if the trend were like flat, the estimates, the expectations are well above that. That's what that's my problem with the estimates is that they're implying things about immigration that just are really rosy and in fact are just not gonna pan out anymore.
Interesting. So this 200,000, this is just in the month of June, or this is the trailing 12 months.
Yeah, this is just in June.
So isn't that still really high? Like it's estimating like 2.5 million people in a year.
Yeah, I mean, if you think about like the U.S. population, right, a 1% immigration flow would be 3 million people or 3.3 million people.
And but these are like, what would you say the average age is? Presumably
do you mean
they're mostly working age, right?
If you look at the breakdown, they give you like single adults. And yeah, I mean, as of this year, about 1.5 million. So, about 2/3 are, say, single adults.
Okay.
Yeah. So, I mean, that's labor force, that's a increase in your labor force population, right?
Right.
So at the current, if we continue at like the current pace for the next 3 months for this fiscal year, we'll be at 3 million. Okay. And that will be above 2022. We'll end above 2022, but below 2023. And the estimates show that peak will be like in next year. So I'm like, well, actually, last year was the peak, right? So like we're already behind. We're going to be behind by like 2 years in the way people are forecasting immigration.
So what does it say then if the economy is going to be weak? Like, what do you have a forecast of this number? And do you see like significantly tighter immigration lasting? And if so, doesn't that mean that the economy is really going to struggle if if this number were to go closer to zero?
Yes.
Do you see this as a kind of a long-term strategy of the United States?
No, I think that generally speaking, so let me show you actually where we've been. Okay, so I'm going to use the CBO's data because that's the trade. Okay, the trade is CBO data. Okay, so this is from the CBO's website. You can just Google like CBO immigration. I'll link them in the chat. So
Thanks.
you can see how historically, the net immigration, okay, or say population growth, right, was declining from like the early 2000s to say 2020. Okay. So in this, and if you look at the contribution from net immigration, okay, the births minus deaths, that's because we have an aging population, right? And our the birth rate, the fertility rate's not very high. So we don't have like the replacement, where we're declining from like a, say an organic population standpoint. Okay. So generally speaking, the contribution from immigration has been between like, 0.6, 0.7, so 70 basis points down to like maybe 1 basis point. Okay. So that's like the range of the immigration contribution. Okay. During the Trump administration, which is in this period, okay, you saw that the contribution went
So
from
wait, sorry, are you
roughly about
sharing
like,
your screen?
yeah, you guys not see?
Okay, yeah, I can see it now.
Okay. Let me see if I could annotate. Okay. So in this got it. Okay. So in this period, so we just look at like the range, right? What's the range? It's between like say a 0.7 contribution to the upside to about a 0.1 contribution on the downside. Okay. So like this, for example, that's close to like a 0.7% contribution. This is like a 0.1 contribution. Okay. This was obviously the GFC. Okay. And this is like Obama's term. Okay, that's like Obama. And then this was Trump. Okay. This is under Trump. Okay. So what was the contribution, under Trump? Well, the population growth fell. But obviously, look at the impact that COVID had. People don't talk about this, but the impact of COVID is a structural change in populations. I think that it's more of a headwind than people anticipate. But okay, if you look at this range, what you see is that the net immigration was probably about like 0.25 at the high end of Trump's time in office, and probably close to, let's say, like probably a 1.2 on average. Okay, or sorry, a 20 basis point or a 0.2 on average. Okay, so this is where we are today, and you can see that the surge is over or about, say, 1%, and this is like 2023 or 2022, and then more than that in 2023, and about the same in 2024, and then still a significant amount in 2025 and 2026. And structurally, this is all the same. Okay. So this is all like a 0.3 average, but this, okay, is a 0.6 average, and this is like 3x the Trump average. Okay, so this is an overestimation of the net immigration during a Trump administration. So that's number one. That's point number one. Okay. Point number two is that actually Biden himself has clamped down on immigration. And so this year, it's going to look more like, let me change the color. And this year, it's going to look more like, and if Trump does become president, then it's going to look like, like that. Okay, like that's what it's going to, that's, well, okay, that's what it would look like. So you can see that it's like quite below where the projection is. Okay, but especially in this time period, okay, especially in this period, okay, which is very important. So this is the trade. This disagreement that, that you're going to have another 2 years of very high of 3 million or like close to 3 million immigrants. Okay, historically, that number has been about, the average has been closer to like a 0.3, by the way. Okay, so that means that if the US population is 300 million, okay, the average increase is maybe about, like 300K to 500K. Okay, that would be like the range that we would expect. And so currently, how do I stop the? Okay, so currently, how do I stop this? Uh-oh. Interact with, okay, here we go. We're back. Okay, so currently, like if this is what the view is, well, this is showing that it's wrong. And why is it wrong? It's wrong because there's been a policy change, and there's going to be a policy change. And the policy change has already happened. So the policy change is that, as of this year, Biden administration has increased its scrutiny and of border crossings and has limited the inflow of people, and has also increased the deportations. Okay, so that's a policy change. That's done now.
Where is that data available, the policy change?
You could, this is just like by knowing, you can do like Biden immigration.
It's like normal news.
Yeah, exactly. Like, this is like new actions. So for example, deploying more people to the, the border, revoking, so on and so forth. Actually, it was earlier in the year that they began to make the bigger shift. Okay. But yeah, you could just kind of read through what's been actually happening. So, this is just by like, scrubbing through White House press releases and what they've been saying.
Nice, thanks.
Yeah, so this is like an example, of things. So it's like it's a lot of incremental like points.
And presumably that's going to be ramped up to counter the Trump voters that care about this.
Well, you could say that that the impact has happened, and so what the impact happening, then we could assume that then the really big numbers that we saw earlier in the fiscal year are going to be probably lower. So I would probably assume that they would be closer to like that May average, and that does result in maybe like a 2 million run rate, maybe above a 2 million run rate. So I'm not saying so under Biden's, after he initiated, this change, we're still running at like a 2 million plus, immigrant run rate. So I'm not saying that we can't have, that's like out of the picture, but it's lower than where the estimates are. Like that's my point, is that it's quite lower than what this estimate is.
Do you think new births from new immigrants are factored into this estimate?
It should be, like, in subsequent periods, you should expect that. Yeah, but the composition shift is not big enough. Like when people live in a wealthier area, they just tend to have fewer children. And so what's the terminal amount of children that any family has? Probably two and a half, maybe. And so even that is above where we currently are. But that's barely, that's enough to like keep population, growth positive. But we went through a 200-year period where families were having like 20 children, right? Like, how many kids did George Washington have? And then after that initial massive, those big waves of population historically, especially as like medicine became better, allowed for just more people to live. And so you went from having a population, a total global population of like 500 million for many years, and then a surge to, 7, 8, potentially up to 10 billion later the century. So, the thing is that like the global, human population is probably like in a little bit of a bubble and needs to come down a bit. That's, I think, okay. Um, but to get back to your question, would the number of immigrants really shift this? No, because it's too small. You got 1% of the population that has, say, a higher fertility rate or a higher birth rate. That's not going to shift it's not like those people are having 20 kids, right? They're having maybe like 3 or 4 kids. And so that's still not enough to really shift the trajectory.
Interesting. Why didn't you see? Presume this seems like such an obvious thing to do, though, if you are an aging country. Why are other countries not doing this? Why are more countries not just doing this deliberately?
Well, I think it's hard. It's not easy because you often get so there is a country that did something like this. That was Germany in 2014. They took in like about 1 million Syrian refugees, which was honestly quite a smart thing for them to do. But the thing is that, you get a cultural backlash because it takes time to assimilate, people. And, humans generally are not like super xenophobic, like naturally, but you do have people do coalesce
Stick together.
around cultures.
Yeah.
Yeah, but it's more like culturally like the culture matters more than like the skin color, for example. And we have evidence of this because if you go back to like, prehistoric times, you go back to like like you trace how different haplogroups have evolved. You'll see that there's like a lot of mixture, right? Like who would have thought that like people in India are related to people in Northern Europe? Like that's like so weird. But the thing is that they have some genetic differences, and so that meant that they were like they people came from different parts or from different areas and looked different, but then they adopted the same they adopted cultures. So the culture that when people will say like prehistoric like language or culture, they're not talking about like wasn't a group that looked homogenous. It was actually a group that would have looked pretty diverse, except that they shared the same culture. And those cultures, by the way, would spread across the globe pretty quickly, like faster than you would have expected, considering that they didn't have like horses and trains and cars and planes, right? But you still saw like when people learned how to make pottery in one part of the world, it didn't take long for everyone else to figure that out, right? And so that meant that culture, diffused through the world. And that tends to be what happens is you instead of seeing cultures as like static, like oh this region or like a geography, this is a fairly new concept. A better way to see it is that like there are problems like getting food or storing food or getting water or improving energy or so on and so forth. And when someone figures out a way to do it, that new technology is shared or ends up spreading through every corner of the world. And that has always happened. Um, in the or let's just say like pre-agrarian societies, the population was not tied to any specific, piece of land. And so populations kept moving. In fact, even like the current, think about like Western Europe, okay? Like Western Europe, the population that sits there did not live there 1500 years ago or 2000 years ago. This is, or where they actually live. It's completely different. You had like the Visigoths ended up settling in Spain, for example. Like they're not from Spain. And so you actually have like a massive amount of like, say, genetic diversity across most of the world. Because you actually had this huge spread of culture and of information. So I think that like humans in general, most people are not like stupidly racist or xenophobic. I think that that's mainly like a modern thing that came out of like the the Atlantic slave trade. So that was more of like a modern thing, but like other than that, yeah, people prefer a culture because they associate a culture with a success, like a technology advancement, right? So like, someone in India thinks that their culture is the best. Someone in China thinks that their culture is the best. Someone in France thinks that their culture is the best. And that's like typically what happens. And if you're in India and you go to France, there's an expectation that like, oh, because you're going to their culture, so you join their culture pretty much. That's like the idea. um and so I think that is the part that is tough. Like governments don't know how to address that because the whole concept of even like a nation state is fairly modern, right? So like they just don't know how to like deal with that in a good way. Now, federations like the European Union and like the United States, that's actually how you should do it because like in the United States, the population is fluid, right? Like people come to California, they learn how to do things in California, and then they move to a different state. And so California culture spreads throughout, the United States. Someone from, Georgia comes to California and shares something that like people do or something that's great that they did in their state. And Europe has like the same thing because of the Schengen laws, right? Or the European Union at least. And so that allows for populations to flow. So that was a really smart thing, I think. Although with that does create now like regionalism, So it's an interesting dynamic, but it's not dissimilar with what you saw under say like other major empires like the Persian Empire or the Assyrian Empire or the Roman Empire or the Ottoman Empire, where you know like the people that rule, say, Europe, like the European Parliament, they're not. It's not like, you know, you could be from any part of Europe and you can get voted into that, right? And so that's something that I think is an important, aspect. But then I think that when you've established a regional kind of regime, cultural regime, it does become hard to assimilate like a big population from outside. And this was a problem that Rome faced too, right? There were, lots of different populations outside of the Roman Empire, and some joined the Roman Empire, some took over the Roman Empire, some sacked Rome, right? And so I think that becomes, and that didn't just happen to Rome, that also happened to like every other empire, and I think that's important, because that's the historical precedent that I think people have. In the United States, I think we try to do something like that with like NAFTA. So like try to open up, maybe not have open borders, but like have more of, make it easier for populations to flow, goods and services and ideas to flow between, say, Canada, Mexico, and the United States. But I think that the problem is that you can get populists like, say, a Donald Trump or a Boris Johnson or a Viktor Orban, who can then use a culture war, okay, to consolidate power. And then ultimately it's like, well, why would Orban use a culture war to get to power? It's an easy way to get power, right? So like that's one of the things. It's a very easy way to kind of create a following. And then the other thing too is it's not a policy outcome. If I have a culture war, I'm just like, I'm against like gay people, or I'm against like immigrants, or I'm against like people from a certain part of the world. That's not really a policy. That's not a technology difference. You- And so because of that, I'm not held to like I don't have to be smart. I don't have to actually like fix something. I just have to, I'm a content producer. I just produce content that keeps people engaged and riled up. And that becomes like the government strategy. So the the thing that we're seeing right now is you see the rise of, populism across many places in the world. And it's because of this, like, you know, it's very easy. Populism is like the easiest clickbait. It's like the earliest clickbait. You just start to, point fingers at other people, and suddenly you can actually create a following. And that's kind of like the dynamic that we're seeing, now. In the long term, I think that there are countries that are better positioned, but they're only if they survive, populist waves. I'm actually very curious though to know like what your thoughts are, because I think that the UK is a really interesting example of both how to like do it right, but also like what happens when it goes wrong. What do you think are some lessons from the UK experience?
I don't know. I wonder. I think the assimilation factor is important, and I wonder what. I mean, I'm suspecting that is what like these demographic quotas are about, and it seems like that is a pretty blunt way to do it, but it would do it. So
Right. Yeah.
I mean, I can't think of any other way of. One of the big, I just think it's going to be interesting, is that in England, minorities will. There's like certain towns that are like packed with people from one part of the world,
only
and
costs for some things.
I don't really know what you should do, if anything, in that situation.
hmm
Uh,
What what do you think of like whenever I think of like, the UK, like I also think about like the difference between, say, like England, Scotland, Wales, and Ireland, right? And to the point where you can have people in the same geographic area that still have such a distinct culture, right? Like you know, you go to Glasgow and it's a very different experience than say being in Manchester. And there even is still some legacy of hostility there, you know. Is that like, you know, because like, I mean, isn't like a bunch of Scottish people in Glasgow the same thing as like a bunch of Chinese people in a town, or like a bunch of like Pakis, like, you know, taking over city council somewhere?
I don't know. I'm sure to some people, I think some people will play that kind of tongue in cheek just for the sake of being on a team. But I think actually most people don't. In England, it's not really. No one really has that view, actually.
Mm-hmm.
At least not
Interesting.
seriously, you know. Although there are some people, I've had like a few northern people hear my voice and just be instantly like cold because they think I'm from the south. And but it's really rare, and it's not
Yeah, so I
Well, I don't mean it I don't mean that it's like hostile. I just mean in the sense of like it's
can you share?
you know, it's they, you know, it's a different, like the people in Scotland don't consider themselves English,
Oh,
right? And so like
Right, yeah.
they've not fully adopted, like, you know, are Scottish people like broadly European? Yeah. Are they like part of Greater Britain? Yeah. Are they English?
So I think this is, you know, you said that that like everyone likes their own culture. I
Mhm.
think England has something. I think England is kind of the opposite. That everyone in the United Kingdom kind of hates their culture for some reason. Like, you don't have to have a reason. It's just we love to criticize like whatever is in front of us, and I think we are a bit united in that.
okay, yeah. I think
That's
I can
funny.
get this
That speaks to like the British pessimism.
Right.
I
Yeah.
I used to have uh you know, like, I'm sure, you know, Andy, or, you know, you guys, I've also, you know, worked with like, you know, colleagues from the UK, but it was just always hilarious because like the London team was just always just such a big difference culturally. You know, it was like, you know, almost didn't matter. Like we would joke that like it didn't matter what was going on, but it was always a great A in London. So it's
What
just
do you
kind of
mean a
funny.
grade A?
Like people were just like upset or like pessimistic. Like
Oh, I see.
you
Okay.
can
Yeah. Yeah.
you can say anything and it's going to be like, oh, for some reason it's going to be like a net bad thing. Um, and then it was like, you know, because we had French colleagues too. There were actually a lot of the French schools are apparently have like a really good math program, and so a lot of like credit traders are French, especially in the credit derivative side. And so you get these like interesting cultural dynamics because of like the desks. But it was we always saw it as like a joke. And of course I'm sure like for people there, like they thought that people in America are, different, too optimistic, right? Or something like that. But I just think that that dynamic is pretty funny. What I thought that was like super interesting was that people from like Japan were similar to like people from like the UK. Like they both have that like it's like pessimism, embedded pessimism. But people from like China or Hong Kong or Singapore were more like Americans in that they were like, yeah, we're gonna go and we're just gonna like make money or like go do something. So I always thought that was like very like interesting like cultural difference. But like going back to like the broader point, which is like how does this, impact, immigration, and like what does that boil down to? I think ultimately it's that like if you look at a lot of the immigration flows, immigration primarily happens like historically would happen because like a river would dry up, or because the cattle moved, like you're herding your animals, and like my ancestors, were like would tend to sheep, like this is like maybe a few thousand years ago, and so they went from like somewhere in the Middle East to like the subcontinent because of the sheep. Now they could do that. They could travel through that at the time because in the time that they made that migration, it was under one empire. And so because it was under one empire, they weren't crossing borders. But you think about like leaving or going outside of that empire, then yeah, you would have more trouble. At least in a this is like a more modern construct. And empires were broadly regional, and so you had like Chinese empires, you had Middle Eastern or Indian empires, you had Mediterranean empires, and then you had European Northern European empires. And so I think that created this, we get this like sense of like regionalism, and that kind of binds people to that. But this is a fair still like in okay, so that's one setup. The other thing is that nowadays, if you look at where all the immigrants are coming from, they're coming from war-torn countries. What's driving these wars? Well, this is where it becomes a big problem because it's like there was a civil war in Syria, right? And the civil war in Syria was pretty much Russia versus like Turkey, that happened in Syria. And so Turkey is a NATO ally. It's like half European. Russia has its own, you know, uh, imperial, leanings. And so they had this war in Syria, and then you had people flee Syria because of that. And so you had a really big increase in immigration because of that, the lack of stability. Similarly, you have the same thing like in Libya or like Afghanistan. Like you can just like name like where are immigrants coming from, and it's because there's like major instability or economic depression, in a region. And this is why, like to some degree, so I think like there's like two types of immigration, right? There's like intellectual immigration or like inspirational immigration, and then there's like required immigration, right? So it's like one is where like, oh yeah, you know what, I want to move to France, and it would be cool to move to France, and I'll learn the language, I'll learn the culture, and I'm going to study at the Sorbonne or something like that, right? Eat croissants, in Paris. And then another type of immigration is like, I just need to get the heck out of where I am, right? And so I think that like the first type of immigration, that's like what that I think everyone is pro that. And I think that's generally like there are some people that are against it, but I think the people that are against that, I would say those are like racist people. Like that's like there's something that's like wrong with you if you like if you want to stop like someone from another country from like studying at like your university and like learning your culture or picking up these things, I think that is xenophobic. Let's put it that way. I don't want to use the R word, but we'll use the X word. But I think that for the immigrants that come from where it's like an economic situation where like they don't have food or water, or they can't provide for their families, or there's war, then for those there's like a kind of a moral obligation for some sort of like temporary sort of support with some kind of promise of something to like restabilize the region. Now, it just depends obviously on the country. So it's like I would say, the United States, like, we went into like Iraq and Afghanistan and kind of created a lot of the turmoil in that region. And so because we created the mess, I think it is only fair that like we then, take our share of the refugees and the immigrants, because like we went there and, bomb their cities. Now they can't feed them. Now they, or burn their fields, so they can't, feed themselves. So there's then this like moral obligation. And that moral obligation also results in two elements. You have one, the people that are saying like the more, I would say, reasonable, who will argue about what is the number of those types of immigrants to accept, or like what is the amount of like aid you should send to those region. I think that's a fair discussion. should you send 1 billion or like 1.2 billion, right? I think it's important to, you have to have feedback involved in there. But then there's like another component, and that is again the populist angle, which is to say, like, why should we give anything to anyone else, right? And that is problematic because what happens is you start to create an environment where there's a couple of things that happen. One is you actually increase the amount of like resource competition among other countries, because what that means is you can now go into another country devastated and then like extract its resources. And this is kind of what happened in like the, mercantile era, the from like the, say 15th to 18th century in Europe, is that they went into like a massive resource competition amongst countries, because at that time in that region, you had this like, yeah, we don't care, what happens in another place. And so you get that massive research competition, and that results in, a legacy that obviously I think a lot of people are still trying to grapple with. So, and I think that everyone can agree that that's like generally like not a good thing. And so this becomes like the setup, right? So populism will lead us to that, it's in that direction, right? Because if you think about any country, right, you have a limited amount of resources. And so, ideally, like eventually, right, you're gonna have your fill on the resources that your country currently has, and then you need to get resources from somewhere else. And the problem is, if you don't establish goodwill and trading relationships with other countries, then you're not going to get access to those markets. And so then the only way for you to get access is through, some more military action. This has been like the historical precedent for, for many wars, historically. So this is why I think populism is like dangerous, but I don't think it happens overnight. Like I don't think that like under Trump we're gonna go and invade another country and extract all its resources. But what happens is, and it's not to say that we haven't been doing that over the past, few hundred years anyway, right? But it's to say that, are we like headed towards a larger resource competition, or are we trying to reduce the resource competition? In the early 2000s, after the fall of the of USSR, it seemed like the world was shifting away from resource competition
Yeah.
and into an era of collaboration and globalization, right? And so you had more trade with everyone. And that led to like this unprecedented amount of prosperity across the globe. Billions of people were lifted out of poverty. We saw the miracle that happened in China, that kick-started a lot of miracles that happened across, Asia and Latin America, even parts of Africa were able to develop very quickly. And so, that was a good thing. But then to kind of, now the problem is though that we have people that have been able to leverage populism to gain political power. And in that environment, again, because populism doesn't aim to like really like solve a problem, it's more about like just generating content to, it's like engagement farming. So it's just you're not really working on addressing the problems. In fact, even your strategies to address the problems, like in the ideal world, they're just neutral, right? But many times they're actually detrimental, because when you have a populist parties, especially if it's populism with a cult of personality, then it becomes more like a cult. The problem with a cult is that there's like secret information, or like, I don't want to call it inside information, but like they call it inside. It's you're on the inside. And so what happens is you kind of suspend your disbelief, and you just pretend that you're in this fantasy, right? And like you keep just like pushing the fantasy. The problem is this leads to catastrophic failures. And so, it becomes like a dangerous problem, I think, for countries in the longer term. Like this is, I'm more worried on like a longer term stand than a short term stand. But that's kind of my take there. I kind of rambled a bit, but hopefully that at least gave you some insight into like maybe how to like think about, or like why there are some imbalances, or what's like the motivation for certain strategies. In the US, we actually call that strategy the race to the base.
What is the base?
The base is like that populism, like whoever's like the populist faction within your political party. So if you just like engage that group and you get them riled, like those are the people that are, maybe it's like 20% of Republicans and 20% of Democrats, or like 20% of the people in any given party are probably the type that are like super fans, right? And so they're like super engaged. They'll read all your content. They'll believe all your conspiracies. And so, in the old days, or, I think I actually, it's not even old days. This has always been a problem, but there is a group of people that think that, politics should be like, you should in the ideal world, right? So this is idealism, right? Politics should be about, telling the truth and come together to solve problems, right? Like that's what it should be. But the thing is that people can find that there's a problem, there's a behavioral problem where if you have like a group of 100 people and you have two noisy people that like say that they think that it's too hot, the rest of the group, if you survey them, will tend to agree with them, even if they don't individually hold the same views. And this is like a known behavioral thing. It's like you'll see videos of economists like joking around by like pulling a stunt, like they'll go to like a dental clinic and they'll have like one person like randomly like stand up every 2 minutes, and then by like the end of like an hour, everyone in the in the lobby is doing the same thing.
Oh, it's just.
Because people just tend to follow that group dynamics. So if you can amplify that 20% and you win over that 20%, then you can control the rest of your party. And that strategy is called race to the base. And that's, inherently a populist strategy. In the US, it was called this, but there's, this is nothing is, new under the sun, right? So this is an ancient strategy that I'm sure people have been, deploying for since humans first, came out of, the Rift Valley.
The main things that we'll have to focus
Interesting.
on
I'm
is
going to share
rating, probably
a link in the chat here.
There's an electrical panel that doesn't have
Some interesting
cover.
psychology
There's a lot of
studies
mechanical equipment that
on
needs to be replaced.
the
I know
need
some
for
of our
attention
guys
to see
have that.
change.
For me, I kind of run warm, so
So I
on
wonder
my
how
side of
much
the unit, it probably doesn't matter, but a lot of it's actually
people are just
tenant side.
more aware of things
Like
that otherwise they
legally,
wouldn't have been aware of
You have to provide heat to a tenant.
if everyone else wasn't talking about them.
If they
Right.
If they complain, then
That's a big point
if they're
too.
living there and they're not complaining, we probably don't have to talk.
As fascinating as this topic is, though, let's go ahead and pivot to coverage. How does that sound?
Yeah, great. Not much to add from me today. I've been working on my school stuff, which is on Dynatrace. So I'm going to be building a DCF for Dynatrace. That's basically my update for the day.
All right, cool. Can't be posted.
If we make an offer without those,
Sounds pretty good.
we're just kind of accepting that if there's a problem, then there's a problem.
Yeah, I don't have any big updates on my end too. When do they report?
End of the month.
And that was what basically the inspector said too.
On
we can't go on.
Oh yeah, August 2nd, I believe.
But Andrea pulled up.
All right, that should be that'll be fun to prep for. I'm gonna actually so I normally will draft my earnings preview about, we say like the T14 window. So pretty much like I'm hitting it. So I'm probably gonna draft like a short little note on it, and I'll loop you in on that as I do it, and we can kind of leverage that, I think, in the general process.
Yeah, nice, great. That'd be really helpful for my schoolwork as well, actually.
There you go. All right, thanks for that update. Andy, how's things in EV land?
Yes. Pretty interesting couple of days. I mean, today, as I mentioned before, on the macro side, we had the retail sales not looking too good. So I mean, we're in this kind of like summer seasonality where people come out to dealers and buy cars, and if retail sales down, it doesn't
So I
look good
guess
for the
the
rest of
question is,
the
how
year.
risk-averse
So
are
I
we
know
to
Yafen
an
talked
offer
about
without a real inspection or
the oil
foundation?
side. So I guess there's a little bit of like the bifurcation on the oil side and the retail sales side on the auto. So I'll keep an eye and see how July data comes out. So normally, those will be the summer seasonality. On Tesla, more moves from Elon, right? So Elon saying he's giving out like 40 email to Trump's campaign. But that's not really what I'm focusing on. But what I'm focusing on is what JD Vance said about taking away that $7,500 EV credit. So people are like, yeah, like this is gonna kill these companies that's not making good cars and not profitable. Like, underneath they're talking about like Rivian, Lucid, and all these other like VinFast and all the pure play EV company. But I think this is going to be a blow to more legacy OEM. And the reason is those legacy OEM has been bleeding, tons of money on their EV segment, and their management are cutting back on their spending. Hey, I was like, and then they're switching to hybrid, and they say, oh, the EV doesn't work, and the argument I have is, if you build a really good EV, you don't have to, pivot when people will start buying your cars. So how about making a better EV? So yeah, so this is really the argument. If you take away the $7,500 credit, then these companies will suffer even more, because now their situation is, I'm pivoting away from EV into hybrid. But if the industry trend or the adoption rate in EV is higher, then they just miss that whole market. So that's their problem. For EV side, for the pure play EV side, I'm not super worried. For Tesla, number one, they are the starting point of the price war, right? So they'll be happy to see taking away that $5,500 is gonna hurt their competitor more than themselves.
Yeah.
For
So I guess
Rivian and Lucid,
just to give you a
you think about it, they don't really
picture, it's
sell any like cars, like big
it's about
volume
100 years
cars
old, right?
with that EV credit. So I
Yeah,
mean,
and
I don't see how it impacts
it's just
their
a
balance
really
sheet. So
I really like the layout
um,
of it. There's like you walk into
that's
the
something
living
I
room, and
picked
then
up.
there's like kind of a
Rivian, not too
separate
much,
dining space. You can
but they
even
raised
there's
the
like a
price target
pocket
from
door that
14
can
to 16. I'm
close,
still
and then
waiting
there's
for
like a
Bloomberg to have
kitchen.
that delay report. I'm not using AMR on that one.
Fine. And
And
then
on Lucid, it's like big update on Twitter. Like they breached that 5 miles per kilowatt hour. It's official. They're launching this 2025 model, even smaller battery with an 84 kilowatt hour battery. And what it's well, why is it good news to me? Because it shows that management actually figure out like how to hit their milestone. Like they had this issue with their air launch, their gravity launch, and all that, and they have been undershooting their targets for basically the last 2 years, and now they claim they have hit that target of efficiency, and EPA's already approved it. I think it's really good, and they can use that as a advertisement opportunity for, let's say, future partnerships. And what's the other thing that's really good about Lucid right now is they added the heat pump to their model, meaning even more efficiency in the winter months, and specifically for markets like Canada or like Northern Europe, or like the Seattle area, right, or like the northern USA where the winter is colder. But this is a trend where the industry is going. We've seen Rivian switching to heat pump in their Gen 2 R1 vehicles, and for Tesla, they are like 3 years ahead of the game. They already installed it starting in model year 2021. So I mean, big win for Tesla. it's good that other people are playing catch up in this field, and I really see the competition getting much more fierce when Rivian and Lucid launched their mid-price platform in 2026, because each of them are kind of in the lead for different things. So Tesla, obviously, biggest player here. They have the autopilot. Rivian, good design. Nice CEO, like off-roady Range Rover kind of look. And Lucid on the efficiency side. But what I've seen over the last month is each of them are closing the gap on each other's strengths. So it'll be interesting to see how these competition plays out. On the Porsche side, they expanded their Macan EV range. So they added the rear-wheel drive version and the 4S. So it's like more like a high-performance version of the of Macan. And the one thing I picked up was they switched to a silicon carbide transistor in their inverter. So when we had the meeting with Lucid, we actually see that they said silicon carbide is the way to go, even though it's more expensive as a material. So we see more and more EV makers adopting that technology. Then it will bring the BOM cost down for the silicon carbide. So I think that's where Lucid is in the lead and people are following. So overall, that's on the news side, what happened. And I want to specifically talk about Lucid today because the stock is up 10%. It has been a volatile ride. Since last Friday, we have that big jump, and then yesterday it's down. I think it's around like 10%, and today we kind of made up on the loss yesterday. Not like fully, but like we recouped a bunch of the loss. I checked the option market because apart from the news of the 5 mile per kilowatt hour, there's not really any major news coming out. And I think if that's the case, then what about the option market? So I went in, checked the option market, and then saw for the earnings, there's more option being bought in the $4 range. So let me actually share my screen on that. It's easier for you guys to see. 1 second. Can you guys see it? Good. Okay. So, a couple of days ago when we we're looking at this, August 9th, which is after their earnings, we saw a bunch of call option buying at $3.50, and we believe that caused the massive move, on Friday when it rallied, for the reasons we already discussed. And today, I checked the option structure and I saw the $4 actually, has tons of open interest, and those positions are open in the last couple of days. And on the $4.50, we also see tons of call buying. So what that tells me is, actually the $4, it could be pretty even with the call input, but $4.50 we have like almost 2,000 contracts open. So I'm not going to trim too much on the long position. The reason why is I do have this feeling if I want to be exposed to the upside if there's a deal being made on the partnership side. I think that's something that people are hoping for. And the risk to the downside is not that much. One, we got this really nice Q2 release number and then we want to see we want to look into the details to see, the geographical component, whether it's driven by the Saudi or it's driven by the US. If it's driven by the Saudi, then I think it's it's less of a good news because it doesn't support the central theme of EV demand recovery in US. But if it's driven by US, then it's great. But one upside from the Saudi is the ASP of the vehicle is definitely higher towards Saudi because they're buying more of the high-end vehicles there. So that's why I think the risk is the upside, and I want to be exposed to that. So we'll see what happens, and that's my analysis so far. Mo, if you have any takes on the option side.
Yeah. So kind of a couple of things on the option side. Now, this is good, analysis. So one of the things, just as a good reference point is that I think the number of, if you just like add up, so you subtract the the lots from the put side and you add the lots from the call side, and you're going to get to like a number of shares, right, that need to be bought or sold, and that's where Bloomberg will tell you that implied shares to be sold is like 423K. The today's volume on the stock was 60 million shares, right? So, the like an incremental like shifts in volume or open interest, it's not going to move.
Sorry. One sec. When you say implied shares to be sold, is this number here, right?
Right. Yeah.
So what is that implying at expiry or like?
Just from a hedging, like that's what needs to be sold to hedge that's how many
Hedge
shares would have had to been sold to hedge the position.
Hedge the positions on like the overall option market here.
Yeah, like based upon the delta. Yeah.
Okay.
Yeah. So like on the to the left hand side, so it says delta lots.
Mm-hmm.
So you can kind of see, you can just like add those up and then times 100, right? So that's how you kind of get to that number. And then if you look at like the actual so now I'll go to AVAT.
Okay. Yeah.
And yeah, you'll see that the 20-day is 35 million. Okay.
Mm-hmm.
Now when you see this, like this is like a consistently like strong, like this tells you that like people are like buying into the stock. However, I would comp this to IWM or compare it to like Rivian. Like what happened to Rivian?
65 mil. Well, I try to have a lower.
Interesting. Yeah. And then what about Tesla?
Yeah.
And then do IWM. And then do HRA, IWM to Lucid. Oh no, yeah.
So are you trying to find out the
And
independence IWM, right?
Yeah, I just wanna understand like how should we think about do we need to make a deduction? Do we need to like adjust our thinking a little? Yeah.
Wait, I think Lucid is in the 3,000 or 2,000.
The 2,000 is the lower. So Russell 1,000 is like larger. Is Lucid in the Russell 1,000 or the?
I think it's in the 3,000.
Okay, but is it something lowest market cap Russell 1,000? No, I think you're right. I think it's in the Russell 1,000. That's a good point.
It's in the 1,000.
Yeah.
Wait, it's not. demand. If it's not, what's the 1,000 one called? 1,000 IWB.
Right.
Yeah, it's in the
So
1,000.
So that would be a contingency.
Okay.
Okay, yeah.
Like,
So it's IWB then.
Yeah.
or what, can you just bring a contractor out without,
Daily return?
how does that work?
Yeah, you can do daily for like the past say 6 months. Okay, now run it against IWM. This is IWM.
Yeah.
Right.
Yeah, a little bit more correlation.
Okay. And then do Rivian versus IWM. Yeah, so like what are we trying to understand here? What we're trying to understand is lucid flow the same as this IWM flow, or is it is it idiosyncratic, right? So
Right.
has there been, besides that press release that came out this morning, has there been any big like update? Well, you saw the equity research, right?
No, that's for Rivian. That's for
there was
Rivian.
okay. When was the last week? Stephen Fox, remember that guy?
Yeah, Foxy.
Yeah. Um yeah. Okay. No, that's that makes sense. Okay, so the only big incremental bit of information was this press release that came out, right?
Mhm.
Okay. And you don't think that would have induced flow? Like that wouldn't have changed anyone's opinion about whether to go long the stock,
No.
right?
I mean,
And then
it is being communicated before, right? It's not a new piece of information.
right.
Yeah.
It's nothing incremental.
Yeah.
And then let's see.
So naturally, I was like, it's either the option, right, or
Well, the
know,
change in options is too small now. If
it's
you
not
had
enough.
it in one go, yeah. If it was like in one go, then yeah, that could have done something.
All right.
But
So this is the little hunch that I had earlier on in our group chat. But it's like, if we have a more US centric policy, then it's like, I put the economy aside, right? If we have more US centric policy, it's gonna favor those companies that have a bigger share of profits from US, and it's gonna hurt these companies that have shares, internationally. And that, I think my view is like the Mag 7 has more of the income from the whole world, because think about like the ad, the AI and so on, and those are like all like global stuff. But for US only, it's gonna be more like the industrial and the local economy and so on. And I think the Russell might incorporate more of that versus like the Mag 7. That was like where I was going with my thought. But I do agree with you on the economic side. If the economy blows up, then no one can
yeah,
survive.
I think like whenever we talk about things like, oh, I think this is going to be good or bad, what I recommend is, and it's not because I disagree, but try to boil it down into like what is the KPI that's being bet on, and then what's the time frame? What's the catalyst? How are we going to know that you're right or wrong? And then like try not to make it a perpetual, like oh, like if Trump gets elected, it needs to be like, well, if he gets elected, he is going to have a treasury secretary or like a, and what is that, who is that person going to be? And are they going to enact, a tariff? And when will they enact it? If they enacted it by Q1 of next year, right, how is this going to impact things? I
Right.
think I think that like so like Lucid, for example, they have a Saudi facility. So they're
Mhm.
gonna have like a pretty big international revenue contribution. Um and so what I guess I'm saying is like, no, I think it's okay to think that, okay, maybe there's a view about like IWM, but like unless you're buying IWM, then you're speculating on why other people are buying IWM. And I think that's where, unless we can get very specific on what we think that
Mhm.
is, it gets tricky. What I think like the bet specifically is that it's not really a lot of new flow. It's like residual overhang. And so, and it's residual overhang and that catalyst to like see when that overhang gets impacted is going to be as we move into the next half of earnings season. And so that's going to be around, the end of this month. And that also lines up with when the Fed, the FOMC meeting is. So I would expect around that time that, that would be the catalyst. Now, if we get incremental information through earnings season and over the next 2 weeks, yeah, we could know this sooner. But that's kind of the
Mhm.
dynamic that, and I could be wrong, but I'm gonna know why I'm wrong, right? I'm gonna know when I'm wrong, and I'm gonna know why I'm wrong, so I can learn from that experience.
Mhm. Mhm. Gotcha. Mhm.
I think on like just going back to Lucid, I think that, what we're seeing is just a continuation of that, where the stock is re-rating, right? So, you know, we put out, when we first did the analysis, we said that the stock could go up to 4, and
Mhm.
could rally further, right?
Mhm.
Thinking about positioning into earnings, okay,
Mhm.
assuming the scenario that we're expecting, like, okay, are we rating because of an improving dynamic for, um, an improving dynamic for EVs, where's the stock going to go?
That means I need to pull out my model.
I'm loading it up too.
Right. Let me close
So
share
are you
screen and
okay
share
with
my
that?
other screen.
How that works out on your
One
side?
second.
Or well, Andrea was saying maybe they'll be so pissed off that if we outbid them,
Okay.
they'll
Okay. So here we go.
backdate it to market value.
I was playing around with the numbers. Also,
Mhm.
one thing I want to share with you, which is interesting, is I was gonna see how much cars they need to produce for them to make actually a profit, not just gross margin profit, but net income profit. And it turns out that if they went like pedal to the metal, no pun intended, but like they use all of the capacity, if we do the 100% capacity here, then it's likely that they will have a positive net income, and then actually they sell all of those cars. Yeah, like a tiny net income rather than net loss.
Mhm.
So I think in that sense, the management actually they planned out the capacity at a correct level, right? Assuming all of our assumptions correct, like our in our model, then their capacity estimation is correct. They just need to get there as quickly as possible, over the next couple of years. And that's not including the mid-size platform. That's just the gravity and air. They just need to run at full capacity.
But
Um,
Andrea,
so
how
that aside,
like what's the next step as far as getting this
one sec.
offer.
So that aside, I think the next
I think
question
we'll lean
is
towards
going
just
to be
the 1,150,000.
like how much are we
and
going to
I think I'm
extrapolate the
okay
Q2
probably with
performance?
just doing the contractor coming with me, Dad, unless you think.
Well, I mean, we already know pretty much what the Q2 performance is, right?
Yeah, I mean, like I already put it here in the model, but what I'm saying is, how
But
are we
just the-
extrapolating this, or is it
see
just
the
a
unit
one-off
and bring
event?
the contractor, yeah.
Well,
Uh,
I mean, what's going on? Like,
So what's
if
happening? Sorry, go ahead.
go ahead.
Well, does it?
Okay, so I think there's two trends that's happening. So one, management is trying to sell all their inventory. They are cutting the inventory down. That's number one. Number two, they have massive, like, promotion and discount on their vehicles. So that's gonna hurt their ASP. So I would say
Well,
that
in the offer, when we put a
they
contingency,
can
it
get
would look
the
same
brand
either way,
awareness up with
whether you
more
bring the
cars running.
contractor
I have
or not,
noticed
right?
that recently. And they will have a short-term ASP problem, but when the Gravity launch is gonna alleviate some of that pain, into Q4. So that's generally the dynamic I'm playing for. And looking at the history, the maximum production they had was in Q4 2022. So that's 3,400 cars. And we are running at a little bit over 2,000. So in order
And
to
that would
hit
be
that
probably
9,000
more,
target, they have to
they would like that
do
more.
something like
Okay. So we could
yeah,
get
like
a cost for all
average
these little things
2,500
later.
cars
So maybe
for the
we
next
just
2 quarters.
say we're okay with the inspection.
Okay.
So
And now
it can be achievable
What do you
with
think, Dad?
the production upping like almost 400 cars in from Q1 to Q2. I still don't know how much
Yeah,
that
basically.
is Saudi. I hope they release some information to us so we know the actual real growth for cars delivered in US. But look at the deliveries. We grew 21% quarter over quarter. So that's something that I'm pretty happy with.
Yeah, because like their
The strategy worked.
covered up
So,
with the inspector with stuff like
at best, I mean, at worst, we can keep extrapolating this because, we can keep it level at like 2,400 cars. That's fine. But, if we're producing 9,000 cars and we are, selling 9,000 cars, for example, for the whole year, then we are a little bit ahead of, where we I wouldn't say like very much ahead. Like we are on the right trajectory to hit that 9,000 target. Yeah.
Okay. So I like the way that you laid that out. I would kind of do this from thinking about how the scenarios break out. So, for example, we've got
so
the
what's
the stock. I don't think is going to trade. I mean, like, so the stock is going to trade if the visibility of their long-term targets like come through, right? So if we hear that gravity is
Right.
on track, if we hear that production increases on track, that's
Mhm.
going to drive the stock materially higher. So that's like those are the scenarios. I think we have those scenarios already laid out, right? That the
Mhm.
company can produce X amount by say 2027.
Mhm.
So that's like the baseline, view from a production standpoint. And the question is like, where should the stock trade, if that's what's going to happen? Okay, so
Okay.
the stock, and I think in our view would get up to what is that? It would get up to what's the revenue figure? Around 8.9 billion.
even, yeah.
Are you looking at my screen or your screen?
Your screen.
My
Yeah,
screen.
yeah.
Okay.
Yeah. So
Yeah.
2027.
Yeah.
Yeah.
That's
8.9 billion.
That's
Right.
our case. Bear case. 4.5.
Right.
Consensus 6. Wait, actually, 1 second. Let me check whether the consensus has updated. I'm not seeing on my usual tracker, but I'm just gonna do a manual search on MODL. On 2027,
You don't think Wahdy can give us the pre-approval?
Wow.
today?
Okay. So 2027 revenue actually 5,800. So that's even a little bit lower than what we have here. Maybe on that's from Visible Alpha, right? I remember. Yeah. So 36. Yeah. So 25 to 27. Sorry, 24 to 26 is pretty much in line. On the consensus department.
Right. So if you think about that 2027, our case of 8.9 billion in sales, and if I were to think that like, okay, well, where does if I look at a company that's more established, and I think about where valuation can go, at the minimum level, I'm thinking that we get to let's pull this up.
It's north of $4. I see like $4.30.
Yeah. So if we get to a multiple of say like if we look across the globe, let me do this with my Bloomberg is just so slow right now.
What do you think, Dad?
Okay, so Tesla currently trades at an EV sales of 7.4 times. Actually trades at a higher multiple than Lucid.
Yep.
And so that's on a blended forward, basis. So like where could the stock go if you put the multiple at 6? Like I don't think that would be likely, but if you put it at like 6, for example, like that's like how expanded, the multiple could get up to. I think instead what's more likely is we're gonna get to like maybe a 2 or 3 times multiple. And so I would put it at like maybe around 3. That would be half the multiple that we are now. And then where do we get what is
One
what's
second.
the result?
I don't think our cap table is updated with the current price.
Okay.
Yeah. One sec. Let me correct that. Boom.
Okay. Yeah, there we go. So
Okay.
so when you look at it like this, let me see what is being divided.
They'll tell us maybe.
So I'm gonna do 2027 sales because that's when they're gonna hit scale. Okay. And if I apply, say, like a 1 times multiple,
Say that I could do before or after.
say a 3. Okay. Okay. Then
I guess the only thing on the money part, I need to. So, I think. How do you transfer that
Okay.
amount of money? I have.
So this is kind of like the dynamic here. And we should probably make this a little more clean, but and we should like track like our view of like the multiple because that's super important. Yeah, because you always want to know. It's like, what's my view of the multiple? What's my view of the metric? So the company's going to hit scale in 2027. Okay. That's when they hit scale. So
Yeah.
that's the fundamental bet of like, will they get to scale at that time period? Okay. Now, if they get to scale at that time period, what's the revenue? It's like roughly 8.9 billion, right? That's what the stock is pricing in roughly right now. Like the enterprise value is close to 1 exactly.
Yeah.
So that tells you that okay, the market was trading that at a discount. Now it's trading that at 1. But if I look at where the multiple will be, the company's still going to grow like a substantial amount, of revenue over the next, couple of years,
Mm-hmm.
especially as they begin to scale and ramp and so on and so forth. And so you would expect that the multiple would get up to maybe would go from like a 6.7, which it is right now, down to maybe like a 3 or even a 3 or 2, right? So say you took a 2.5, that would get the stock price to about 4 or 10.40.
$10.40. Okay.
Yeah. So, and that would be an EV of 22.3 billion. Okay. And that would be, so so as we get more information, if the information line up, so this is the way to see it, right? Doesn't really matter like what's the actual production number by the end of this year. What matters is what is the production number at the end of this year tell you about whether they're on track for 2027 or not. So if you think about like what's the probability that they're going to get to that 8.9 billion by 2027, you should have like a base case right now, right? And maybe that base case is like, well, the probability that they're going to reach 8.9 billion in 2027, maybe I think that there is only like a, if I think it's 50-50, okay, then I think that I should price that value at 50%. And in that case, I'm already trading at a 2 times, I'm already trading at 2 times EV for that. Okay.
Right.
So, but as we go through time, if I think, oh, there's a 65% chance that this is real, now I get an improving, dynamic. Like we get better and better. Okay. So ultimately, like this is the visibility that's going to lift the valuation. Okay. So like, at 100% visibility, like if you knew today that Lucid will trade or will actually generate 9 billion in 2027, like how much would you be willing to pay for that? Well, on that amount, it's generating 2 billion in EBITDA. If it trades at 10 times, EBITDA, then you're saying that the company will be worth roughly around 21 billion. That's consistent with like that 2.5 times EV to sales that we mentioned, right? So that tells us about where that's going to go, and that would take the stock to around $10. Okay, a little over $10. Okay, so if you knew today that that's what was going to happen, you would say, yeah, the stock is going to price that in 100%, and if it priced it in 100%, and if I slap a 10 times EBITDA multiple, that would get me to around 22 billion enterprise value, right? If I had 22 billion enterprise value, that means that at the time, given the revenue that the company had at the time, the stock would be trading at 2.5, roughly around 2.5 times. Okay, so do you see how there's like that the linkage between the two?
Yeah.
Okay.
Because the EV sales and EV EBITDA, right?
Right. So at that point, we're flipping from say EV to sales to say an EV EBITDA approach. But because today we're using EV to sales, we can approximate what that terminal EV to sales number would look like.
Okay.
Okay. So now with that in mind, this is where I think the stock could go. It could go to $10. Where's the stock right now? It's at 4. Okay.
So you're saying like it's like when visibility improve over the next couple of years, that's the target we're aiming for. Like if this is true, and visibility
we're saying
improve,
that at 100% visibility. We're saying yeah, the stock would trade at say $10. Why isn't it trading at $10? Well, it's because maybe they need more money, right? What's the chance that they're going to get that additional funds? They need, there's a bunch of things, right?
Right.
So all of those are deductions to the multiple. You can just multiply the 65%, for example, like by the multiple, and that would say, okay, 1.625. So that's what you think it should trade at, and that would be a 14.5 billion is then what you would take. And that would mean that the stock is can trade at, say, 6.75. Like, the problem with our little setup right now is that we don't have everything labeled. So we should organize this to make it, very clear, so you know exactly what's happening. And then you want to like capture that view, and then stick with that view. And then what you do is, whenever there's incremental information, I'll ask you, I'll say, hey Andy, what's up with your visibility? Are you revising that up or down? You might say, yeah, I'm gonna, well, I think the car production number is gonna look good. So I think, and it makes sense that if they're able to deliver, right, if they're on track, then it's more likely, right? So you might say, yeah, I'm going to lift it from, say, 65 to 70. Okay, so the stock price can then move up, right? So if you change to 65 and then you make it, say, 70, the next day you say, okay, the stock can move up to 730. Okay, this is how it works. You were accreting to a value. Okay. Now, what's really important is, so now okay, I'm at the visibility. Well, what happens? So say now let's say the stock is now trading at, like, say, 730. Okay. Okay, we're at fair value. What if tomorrow there's a factory gets damaged? So what's going to happen to your visibility? Like, do you think that now is as likely again, or are you going to shift the odds a little?
It's gonna shift the odds lower.
Okay, where would you shift it from 70?
70, I'll shift it down to like 55.
Okay, so then what would you do in that case? Remember, stock is still trading at 730. What do you do?
I'll sell, because
Okay.
right now my PT is like 572.
Exactly, right? Okay, and then the day after that, they come out and they say they're gonna put a ton of money on the repair, and it's only gonna impact production for a week.
Oh, back to 70. Fade the move.
Okay. Now you are able to tie in information to the stock price. You see how your price target is shifting with incremental information, but you
Right.
always want to make sure that it's aligned with information that's coming. And that's why the path, we talk about the path of monetization. You're going to lay out all the little crumbs that are going to, like, shift your views, up or down. So that way you kind of know, like, so I want to be long for next week, and then after that, I'm probably going to want to be short for the week after that, because, like, you already kind of know what's going to happen, like how it's going to shift the narrative positive in this week and then maybe negative in the following week.
Okay. Okay. So one question, like, obviously we did this on the fiscal year 2027. Let's say for another company, we're aiming for 2026. We do it on the 2026, right?
Right. Yeah. Yeah. Well, you do this on where there's the fundamental bet. So if it's 2026, it's 2026. For a lot of companies, the fundamental bet is within 1 to 2 years. Okay, so it's either like this year or it's next year. Like, I'll give you a good example, okay? Apple's new iPhone, right? We're going to get a big portion of that this year, and then another big portion of it next year. Okay? So it's the fundamental bet is over the next 1 to 2 years. Okay?
Okay.
So like Tesla Robotaxi, okay? We have a Robotaxi event that's adding a premium to Tesla, right? You could do this with just even that event, and it would be worth the value that you think that would add to Tesla. Maybe you think that would add another, like, $50 to Tesla stock price. And so you then say, okay, for that $50 that you think it would add to the stock price, what's the visibility of that right now? Oh, it's 40%. Okay. So and the stock right now is pricing in 65%. So you would fade that, and you just kind of keep doing this. That what I'm describing is it's hard, but that's when you get to, like, the trading side of the fundamentals, right? You're now, like, the name, you've carved out what the factors are, and you can start to trade them.
What's interesting is, instead of doing it in the model, you're doing it here.
Well, because sometimes the model is not changing, right? Like,
Right.
I know that, like, there's like Lucid, they're on a production ramp, right? Like, it doesn't matter if they go from if they go from a run rate of 2,200 per quarter or whatever to 2,300 per quarter, right? That's not going to
Right.
lift the revenue estimates materially. So that doesn't matter that much. What really matters, like what people really care about, like I don't care if this month if they underproduce, and next month they're gonna overproduce, and then next quarter they're gonna overproduce. Like, how does that impact my sales estimates that much? It doesn't
Mm-hmm.
explain a 50% move in the stock price. What
Right.
explains a 50% move in the stock price? It's how the visibility towards the fundamental bet is shifting. So you do both, right?
Right.
You gotta update the model because you have to like see how things are moving. But you don't do that all the time, right? Like that's maybe once a month or like once every 3 months per
Mm-hmm.
quarter. But then from there, you're like, okay, well, how has macro information, how has industry
Mm-hmm.
information, how has company information shifted your your visibility and your view of an outcome?
Okay. So basically, when I finish, like operating model, the next step I do have the full like calibrated full consensus and bear, and then using this kind of like a probability approach to deal with the everyday trading,
Yeah,
or
you're gonna
like not
use
everyday
yeah,
trading, but like
you're gonna use this for like for pretty much like everyday trading. But so after you have your operating build set up, just put in dummy variables, and for that, that's why I say just take consensus to
hmm
test their dummy variables. But then you need to create the scenarios. So you need to
hmm
have all the scenarios outlined. And when you have the scenarios outlined, now you know what the bets are. Like you know what you're betting on. If you don't
hmm
know what you're betting on, then you don't know what the terminal number is going to look like. And you have to have conviction in the terminal number. Like, I think with this, like a lot of it, like maybe like I put in. And so you don't have conviction because you're not in my head, right? So
right.
like you need to, when you've replaced the work that I've done, right? And you've added in your own layer. So now you know exactly how it all fits. And
Mm.
that's really key because now you have conviction in your view, and then that's what's going to allow you to then, but you have to have your scenarios broken down. You have to know what your
Gotcha.
scenarios imply about revenue, what they imply about EBIT or EBITDA, and then what they'll apply to on a multiple basis and on a stock basis. So, and then remember on the multiple, like and for the future, it's tricky, right? You're gonna see like, okay, well, 10 years or 5 years in the future, right? Like currently the stock is trading the 5 year number at say 2 times, but it's trading the 1 year number 8 times. Okay.
Mm. hmm
But if the company is on track to deliver, then by year 5, I can use EBITDA, and that EBITDA multiple is just 15 times. That's pretty reasonable.
Mm.
Maybe the comps are actually 18 to 20 times. So, but instead of using those multiples, just say, well, what would make the stock trade at 20 times if it could show that it had even more growth, right? If it was getting even into more things. So now like, what does it need to do in order to get to a 20 times multiple? And then what does it need to do to
Mm.
show me that it's going to get to that metric, by that period? And then
Okay.
you do the math, and then when you price the stock on a 20 times, that tells you that the stock today can trade on like a 15 times EV to sales. It's currently trading at 8 times. So now
Mm.
like, okay, that would be your upside risk scenario.
Right. I think this is actually super valuable when doing a crosswalk between the EV sales and EV EBITDA, and seeing like having further visibility up ahead, and having a comp, for example, like Tesla, and see whether the valuation makes sense. Yes.
Exactly. Yeah.
Yes.
I
Yes.
would say for any of these companies, what you can do is you could say, so like there's yeah, and I want to make this like clear because this is what gets everyone. This is always a really
Uh-huh.
hard part about like valuation. Like, how do you predict the multiple, right? And to predict the multiple, you have to predict what your metric is going to be. Okay, so
Mm.
that's number one. Like, predict the metric, and then you could say, given this metric, okay, where's the stock trading? You know, and then you could say, okay, well, on a 1 year basis, like how is this going to accrete over, to this number? And then you go through and you can say, okay, well, if I have, this, this is going to be my metric, what's the implied multiple, for that, in that outcome? And then you can say, okay, well then what's the EBITDA, in that outcome, and then you can start to like work your way backwards and say, okay, well that then is consistent with a, that could mean that the multiple is really high today, but it's consistent with actually what can happen.
Okay. I see. Okay. Yeah, I'm gonna play around with this tonight and see how it goes and clean up this sheet so I don't need to have to everything.
Nice.
Yes.
Good. Yeah.
Yeah. And just on the progress, I'm still updating the Tesla one. Just finished the revenue build. It's I think with like the leasing component, it's more complicated than Rivian and Lucid. Now I'm finishing up the cost build on Tesla. Yeah.
Nice.
I thought Tesla is like pretty simple, but actually it's not.
Yeah.
Yeah. But yeah, that is ongoing, and after that, then we have all three models ready to go, and it's good to play around with it.
Nice. Yeah. No, that's exciting. You're practically there.
Cool. Yeah, that's it for me. Thank you, Mo. And passing on to the next one.
All right. Hey, Gene, how are things going with you?
Hey everyone. Happy to see you guys go on. I had to jump off for a little bit. Things are good. I'm still just kind of working my way through the initiation on Paycom. I didn't get to do as much as I wanted to last night, so just started looking at the S1 after looking at 10K and 8K last night. So kind of wanted to go back and just see where they kind of started from.
Nice. What can you tell us about them so far?
Not much. I'm a bit confused as to how they differentiate. I know they do stuff like employee management, and they use this term HCM. So I was going back to their S1 to see how they define it, human capital management, but everything I read, it seems different than what I understand human capital management is. So I wanted to go back and just try to see if I can understand their perspective a little bit more. But to me, it seems like they're just a app that whenever you hire someone or you're recruiting, um, that app will track them through their career, whether it's payroll, training, and then ultimately retirement. But I don't. I guess the piece I'm stuck on is what's their advantage over someone like a QuickBooks or something like that that just can do all that financial stuff. I guess that's my thing. And then I've also looked at other companies in the past, and I'm trying to figure out what makes them different.
Yeah, that's a really good question. I think, when you think about like a lot of businesses, there's a digital transformation. That's like the big like thematic shift that's taking place. So, the old days, businesses to manage, their human capital would have to have additional people, like they'd have to have a bunch of people in their HR team. They'd have to have payroll people. They'd have to have, bookkeepers, accountants, so on and so forth. So it got expensive and it was like challenging to organize everything. And it took forever. You didn't have self-service for your employees, so they would have to, fill out manual forms and so on and so forth. So a digital application that actually allows you to do that, that's pretty compelling, right? So
Yeah.
like the first thing would be like, well, are they benefiting from this digital transformation? And then that should tell you that there's two things that are going on, right? One is like, what's their product market fit? Like how good is their solution versus their competitors like Workday or Paychex or Paylocity or these other vendors. And
Yeah.
then from there it's like, well, then like how does that tell you about the industry dynamic? So what's their competitive posture? Are they gonna like win versus those? Do they win in certain niches or like verticals? Like, where are they good at? And then where are they bad at, right? And then you can also like get a sense as to like what's their beta to like the general economy, right? Like what's going to drive their growth? Well, their they pretty much charge the company and then per employee, right? So what do
Mhm.
they need, right, to keep, creating new customers? They're gonna need to win new logos, and they're gonna need to have their existing customers hire more people, right? They can also expand into additional services. So that's another, aspect. And I think that's why I think they started off with like payroll, and they've added, a lot more, other things as well. I think the way these guys are gonna go is probably into some sort of like asset management, angle, which is like probably, manage like a 401k, right? And because that becomes like a, durable, sticky business, so on and so forth. So, that's, they're going to need to find ways to expand their TAM, provide additional services. And then they have three levers that they can use to grow, right? So then you can think about like, okay, well, what's the backdrop for each of those angles, right? For new logos, there needs to be like business formation growth. You need to see like businesses are thriving, small businesses are growing. And I would use like the NFIBs business surveys to really like track that. And then two, they need to see like hiring increase, right? So if there's like, unemployment rate is falling, non-farm payrolls is picking up, that's going to be a good tailwind. It's not going to tell you specifically what's happening to Paycom, but it's going to tell you like what's the setup, like do I think that payrolls are going to increase or decrease over the next couple of quarters? Um, and then finally, it's like trying to figure out like what's their goal, right? Like the thing that I do and that really like helps me is, it's easy to get really lost in um the nitty-gritty details of a company's, business, right? So what I will like really just try to dial in on is, what was their like investor day, or, presentation, or something that really like articulates what their strategy, their like, go-to-market strategy is, or what they're trying to accomplish is. And once I can get to that, um, then I can understand really what like the fundamental bet is. Sometimes there's nothing that's like super clear, like they may not have had like an investor day or a big event like that. And in that case, when I go through and just like, scrub through their earnings, that will often, present, information about like the critical factors. And then I can see like how are they tracking, for that, and kind of see how it goes. Um, so that's usually what I use to like speed up, my processes. Really like try to focus. I need to get to like what's their like, yeah, the fundamental bet. And then once I get to the fundamental bet, then I can, work backwards and deepen my understanding of the business.
No, thank you for that. Yeah, because I was really struggling. And I want to look at their S1. I want to see how, like you said, they've grown and what they offer. So I want to go back and see what they originally came to market with, and then just how they've evolved over the years. Because they IPO'd in 2015, so it's not, we're going on 10 years, so not too long on being publicly traded.
Yeah. I mean, you're on the right track. Like the S1 is like where I'd go if a company, filed it, 5 to 10 years ago. Like I think that it's fair to you could use that. It's what you could use if you don't have like they don't have like a clear investor day, presentation. But the other thing is once you get a feel for what the company, you don't it's not that you need to have like you don't need to know at this point, right? You don't need to know you don't need to know the like the product like so importantly. I would say like focus on like the key facts of like how does the company like generate business? Who do they sell to? What is it like? When you kind of work that way, it's like it kind of helps you in a straightforward way, just like quickly kind of understand the breakdown. And then that's going to allow you to, look to see or look across their presentations and filing, or not necessarily filings, but like their earnings, press releases or their earnings call transcripts to see like what they're talking about. Just like normally what I'll do is like literally like one of the first things that I'll do is I'll spend like 20 minutes skimming through the 10K, right? Maybe like the MD&A and item one, okay, just so like quickly like get a breakdown of like what the company does. And then I need to kind of answer those things like how do they generate sales? Is this a subscription business? Is this and then I need to know what like the tailwinds are, like what's the like the thesis, right? And so on their earnings call transcript, they say what it is. If you go straight to their earnings call, their presser in the second or like the first
quarter?
quote in the presser, the press release,
Oh, hold on.
the last sentence or the second, there's a quote like right at the top, pretty much, and the CEO says what they're focused on. Okay. Now, I'm not going to tell you. You got to go look it up. But
Okay.
it says exactly what they're focused on. And so that's like, okay, that's like your first indication. Okay, these are the things that you want to pay attention to. And then, and I'm just pulling up AlphaSense really quickly. And let's do. One of the things I like is they've got the company presentation thing, so I can kind of like see if there's anything. I don't really see any real investor day sort of an event.
Yeah, I went back all the way to 2016 on their investor relations page. I didn't see any at all.
Yeah.
Yeah.
So then what I would do is like I would go and read the Q4 earnings call transcript, right? Because that's when they're gonna like set guidance, set the tone for the next year.
Okay.
Yeah. So like I would say like and always like go through like the 10K because of the way that the information in the like item 1 and item 7 is just so important. So you should always look at that first because you kind of need to know how things are set up. And then from there, go find the investor day. If you can't find the investor day, I would go to the last Q4, earnings call. And I think I've walked you guys through like I'll go through like I'll start at last year's Q4 and I'll work my way up like to today. So that way I can see like what did they say that they were going to do and then how do they track through the quarters.
Right. Yeah. No, you have done that with us.
Yeah. So let me so like in their Q4 2023 earnings call, CEO says he's going to he discusses his vision for 2024. He says what they're focused on. It's the same language that they say in their Q1 presser. They talk about on the product front what they're doing. They talk about how they're like delivering some of those things and what his expectations are, what they're going to be focused on through the year. So it's pretty interesting. And then I think for guidance, let me see. Yeah, for guidance, they gave pretty strong guidance. They said that they expected 11% year over year. Okay, so that was Q4 2023. Now in Q1, they revised that lower. Oh no, they maintained the growth rate. Yeah, but it came down just a little. I think their Q2 estimate. So like that's that's like important information. Then it's like, well, why? And then with what do you think is like what's driving the difference? It's like that visibility thing. At the end of the day, like that's always what you're gonna like when you get to the trading side, you're always trading like how does this incremental information shift your view on how likely the company is to track to that outcome, right? And so like that's why like when I say when you get information, I'm not saying like of course I say things like, oh, what does this do to your estimates, right? But like the thing that I hope you guys hear me say even more is how does this track to the thesis, right? And so if this tracks to your thesis, that increases your confidence in the visibility of what you think is going to happen. And so that, that's going to, make you more confident in that outcome.
Definitely agree. No, I definitely agree with that. Yes, I got some reading to go do tonight. Kind of work on this a little bit more.
All right, cool. Yeah, I'm working on my preview too, so I'll be able to share some of my thoughts as well as we get through it.
Okay.
Cool. All right, guys. Well, I think let's call it a day, or we'll wrap it up for today. And but great call, great discussion. Looking forward to catching up with you guys tomorrow.
Yep, same. Okay, take care.
Yeah.
All right,
Bye,
guys.
everyone.
Thanks, guys.
Take care.
See you later.